Hi everybody, thanks for tuning in to this broadcast through Facebook in relation to expat tax. UK expat tax is the main focus. This is all sponsored by Expat Focus. I'm very grateful to them for supporting me through all this and allowing me to speak on their behalf in connection with these tax matters. I've known them for years. I've worked with them. I've done podcasts, and there's also a Q&A section in my name on their website. So we are closely connected, and it's a great service. So today's topics are UK tax non-residents, UK tax returns, and other issues surrounding related to that sort of thing. People are leaving the UK, those people who've written into me are leaving the UK for the EU, for the Americas, for the Far East, or they're already abroad working overseas, British people, and they're non-resident. A whole variety of issues, basically. And in fact, so many questions sent in by you that I can't answer all of them individually. I've picked certain key cases, and I'll fan out the questions that they've raised in order to cover what you've asked me. And the long and short of it is, if you think that I haven't covered what you need to hear, not an issue, you can always email me. I'll be giving out my personal email address, or you can use the Expat Focus website. So there's plenty of ways to contact me, and we can have a specific chat about your case, because tax is a bit like that sometimes. I need to know your personal facts, down to number of children, number of bedrooms, would you believe? Anyway, I digress. So yes, I'm always told when I'm doing presentations not to use PowerPoint, not to use death by PowerPoint, because people basically can't stand it and people switch off. When it comes to tax, a few slides or crib sheets are important, because I can't just talk at you for 20-30 minutes. It's very hard to absorb that sort of information. So this is good for bullets and key issues. That's why I've used it, and I assure you I'll keep it punchy and snappy, and you won't be switching off. We'll cover an awful lot of information. Okay, great. So I'm going to move on to slides now, get them open for our discussion. So there we go. It's coming in a minute, I hope, sometime. There we go. Right, so I should say, as you can probably tell, I've never worked on the one show. I worked for the BBC, so it might be a fumble and stumble. I'm just talking direct to camera this evening and covering everything you've asked me for. So I hope you're going to enjoy it as much as I'm enjoying it. So on this slide here, it says who I am, the name of my tax firm. I'm sort of sitting under Expat Focus. I'm their UK expat tax guide, and I also cover a whole number of other countries, but my original training is UK tax. So that's the name of my firm there. We're about 7 or 8 years old, but I've been in this as the UK tax professional for we're just coming up to 25 years, and as it says there, I still love it. And if you were to get in touch with me, you'd find that not only do I thrive on it, but hopefully that energy is infectious, and definitely like to go the extra mile and really get into the detail to deliver answers. Sometimes we can't find any tax reliefs or savings. It's just all about compliance and reporting things correctly. But in most cases, there are some benefits and advantages, definitely. I mean, yeah. 20 plus years, there's always something we can find. Okay, so that's me, and that's the firm Gets. Now, this was the first test case. David is his real name, and David is going to move, emigrate. I don't know if he's moving there forever, but he's moving to Bermuda in August, September of 2021. That's what the plan is. I guess the whole world is subject to COVID, aren't they? But yeah, planning to move over there, relocate, and then he's asked me a series of questions. Basically, what does he need to do for UK tax? How does he become non-resident? What does that mean in non-residence? And that covers an awful lot of the other reviews. Someone was going to Portugal, another person to Cyprus. I remember Tracy was going to Spain. Somebody else to Moscow. Well, it's all similar issues in terms of breaking residence, they call it, or ceasing to be UK tax resident. I'll show you what that means. So anyway, this is your case, David. There aren't any other Davids going to Bermuda. And then my first sort of common sense question on the David case was, where is Bermuda? And the interesting thing for me there is it sits just off the eastern seaboard of North America. Your Washingtons, your Bostons, you're just looking right, you're looking east from there. And the reason I mention that is because when HMRC look at you, they would just have you down as going to that region. They wouldn't be interested particularly in the specifics of the country you're going to. So I'm just talking out there really to other Brits going to the Americas. You'll be treated pretty similarly in terms of your exit process and breaking residence. Anyway, so on the flip side, of course, Bermuda really is nothing like the States in terms of tax. A couple of quick things to mention. Bermuda, the top rate of tax, I believe, is 10 or 11%, and it's definitely not US. It's actually a British territory. So yeah, so it's quite British overseas territory. So that doesn't. It's a bit like a Guernsey or an Isle of Man, in that although they are part of the British Overseas Territory Club, so to speak, they don't have the same tax rates. Anyway, I'm going off on a bit of a tangent, but yes, we've got an individual David going to a low tax regime, and what do we want to do? We want to get a non-resident and get him out of UK income tax on certain items, not all, but on key items like employment income. So here we go, UK tax non-residents. What's it about, David? Why would you want to do it? What's the objectives of it? So left-hand side there, we've got the flag, the Bermudian flag, shows it's clearly a British territory. So there will be no tax on your earnings after you leave the UK, which is immediately after, which is fantastic, because some countries would say, we don't recognise a split year. I know that's the case with Spain, so that if you left in sort of January or February, they'd still say, well, you're still going to wait the whole calendar year, you're still resident for the whole year. Anyway, back to UK, a split year. If you leave on the 3rd, you fly out of the UK on the 1st of September, on the 2nd of September, you can be tax-free on employment earnings, which is hugely significant. And in addition, you can still have a personal tax-free allowance for the whole year. Excuse me. Yeah, so that's that case, yeah. So we'll come on to split year in a second. I'll cover the other issues as well, the other benefits. I just need to talk briefly about the P85. This is the form you fill out to tell HMRC where you're going and when. Some expats don't do it. I would say of clients of mine, it would only be something like 10% of people who don't do it. So basically everybody does it because you're formally notifying HMRC that you are going abroad, you're going to break residence for tax, and it's very important to tell them up front. Far easier to do that than to be doing it not in a backsliding way, but to do it retrospectively. It's harder to put your facts together and to explain why you didn't do it. This is where I tell the Richard Nixon story. So Richard Nixon was trying to become president of the US, and he went up on television for the first time for a TV debate against JFK, and they say that he lost the debate because there was a lot of sweat on his upper lip. So I've got a Nixon situation at the moment, sorry. Anyway, we'll be absolutely fine, we'll carry on, not an issue. We're all human, huh? So the next one is the UK split year. So what we're saying here is what's great about it is, as I've just said really, the day after you leave, you know, you can actually carve off your employment income and you are taxed for, in this case, 4 or 5 months of that new tax year, which is about to begin in April 20, and then it stops. So your UK tax return is not going to have much to report in that year, and you're still going to get the full allowances, so it will deliver some nice refunds in your exit year. Okay, so this next point is saying that once you're non-resident for every year, you can still have a tax-free person allowance. Now, why does that actually matter? Well, it matters a lot because people who go abroad for 2, 3, 4 years don't know whether they're coming back. They don't know their long-term life plans, tend to keep a home in the UK and rent it out. Well, the rent that you get on that, the taxable rent, is often lower than this 12.5K, so it's a great thing to have. That rule applies to Commonwealth people, EU people, not Americans. Yeah, it's unusual actually that Americans are prejudiced in that way or made to look different for tax purposes, but yes, that's the case. Okay, so next. Yes, so how often, another question people ask me a lot is, how often are you allowed to travel back to the UK? Well, the rules on that are, they are pretty complicated, so that's why I put rule of thumb down, 91 days. Some people get 120 days, some people end up with just 45, but fewer than 91 days is a good way to look at it. That's 3 months, 3 whole months of time in the UK. So anybody working, I know COVID days are different because people are working from home, but anybody working and abroad in a foreign location is not going to have that much free time to come back here for that long. It's normally more the part-time person, the non-working spouse, etc. Okay, we'll get the general idea on that one anyway. Okay. Just going to try to stop the share. We're going to go. Okay, hi everybody. So our next slide is about filing a tax return. Now you might think that if you're non-resident, you're cutting ties with the UK, why do you still need to file a tax return? Well, in some cases you don't, but I have to say that in the first year or two, HMRC are likely to ask you for a tax return. They're almost saying, well, we've given you those exit reliefs when you left, but we still need you to report and tell us if you've got any other UK source income. That would be UK dividends, bank interest, etc., that sort of stuff. So, and we've also got that rental income issue, which we talked about. So that is just the sort of thing that, yeah, that's just the sort of thing that we might need to report. Okay, now, here we go. Right, so this next case, we're now moving away from the longer case study, which covers all sorts of issues. I've now gone to specific people who've asked questions which apply to quite a few, where a number of you have asked me this question. So I picked one, and I picked a guy, and then I'm going to walk us through that solution, and it will satisfy quite a few of you, I hope. Okay. So Robert, this is the guy's real name, and he's actually in the UAE. And he's been out there for a few years earning, so Middle East tends to be totally tax-free on income, so there are then questions about moving funds, bringing money back, savings, that sort of thing, and that's what Robert asked me about, which is a very common question. Okay, let's get that out of the way. So Robert is saying, can he bring money back to the UK, and how can he do it? In a nutshell, yes, not a problem. You can bring money back. Let's talk about how and why we might do that. Okay, so I think there was a suggestion by Robert, which often happens. People say, well, I'll just leave that money in a foreign bank account and I'll just spend it, in later life. Perhaps I'll be abroad again. Well, you don't have to worry about all that. You can bring money that you've earned in the Middle East, in your host location. You can bring it back to the UK. You're allowed to do it. The ring fencing talks about you basically creating a pot. So for UAE savings, those employment earnings, if you've got any left, because it is quite expensive over there, if you've got any savings left, you would bring that to the UK in a capital pot and you would put that in an account, but it would stand on its own. So this is what they call the structuring of bank accounts. So yes, so if you end up with 2, 3 or 4 accounts, it might seem a bit fussy, but the UK taxman at some point is allowed to ask about any bank accounts he wants. And if you hadn't done that, then there could be questions about where different money arriving at different times in the UK. So this is a kind of a repeat really of the other idea, which is whereby you end up with 4 or 5 UK accounts, potentially. Unfortunately, it's fiddly, because what happens, unfortunately, is you bring the capital pot to the UK, great, that's tax-free, but then it starts to earn interest, which is taxable. So people then send a little siphon to send that interest into another account. So yes, it is fiddly, something I could walk you through, but if you hadn't done that and people just have a single account that they're pouring funds into from all different sources, it can be fussy and it can be bothersome or burdensome even to tell HMRC exactly where funds have come from. And it's easy for HMRC to say, well, you're unable to prove that this is all foreign earnings, so some of it isn't, they're going to tax it. So that's what we're trying to avoid. So that answers Robert's question, I believe. Yes, you can bring it back. Be careful how you do it. Remember the rules on ring fencing. It can all be done, but just needs to be done carefully. Okay, so the next guy is Roger, another real case. He's already gone to Portugal. So he's already out there, and he went in, let me get this right, October of last year, October 2020, he moved over there. And his question was, how do they prorate reliefs? And will he get some recognition for the fact that he was in the UK for part of, last year? And the answer is yes, absolutely. It's something that we talked about this just a bit earlier about split year, and what we're saying, I've just put here, Roger, you can have full UK tax relief for all of 2021. There's no, that's UK tax reliefs. There's no prorating. So yes, you can have it all. That's the split year benefit again. So great news. It all works out. So yeah. Excellent, and that really answers that question in full. So I think he was imagining having to carve up the year in some way and prorate the bands, etc. In the UK. You don't have to do any of that. You just can claim the lot. However, you can back out earnings after October. I hope that makes sense. Sometimes the numeric example is required, but I'm deliberately not doing that sort of stuff today. I hope you forgive me, because I don't want to sort of lose the audience with too detailed an example. Okay, right. We're now moving on to Matthew, another real case. This is a British guy planning to, I think actually he might have already moved. About a week, 2 weeks ago, he contacted me to say he was moving out to Andorra. So Andorra is a small principality in mainland Europe. You probably know this already anyway. Near the in the Pyrenees, very close to the Spanish border. It's not in the EU. It's within the EEA, though, however. So similar, very similar to the Swiss example, really. Anyway, so the point about this is that we've just got a Brit leading the UK long term and leading investments in the UK. So that's what the question is about. So he's going to go abroad. That's a copy. That's a picture of the capital of Andorra. And he's going to have to retain UK stocks, unit trusts, and other UK-based funds. So that's what this is about. Will he still be taxed in the UK is the question. Let's keep directly to what he's asked me. He's yes, they'll still be taxed in the UK because it's UK-based. It's got to report in the UK as well. It's got to go on a UK tax return as a non-resident. You're still going to get tax-free allowances. In the UK, it's currently the tax-free dividend allowance is £2,000 at the moment. It's not huge if you've got a lot of investments. Yeah, so that would still have to be reported and taxed. Keeping to the question, unit trusts, would they be taxed in the UK? Well, if it's a UK-based unit trust firm, then yes, it is taxable. You can get that unit trust can create capital growth every year, which is taxable in the UK, and it can create interest or dividends or other payment. It's all still taxable. So if I had Matthew in front of you might say, well, what would you do, Oliver, then? Should I therefore move my investments to another city or to another country? And that's where I can't advise. I'm not an investment advisor. And sometimes I say to people, just be careful about letting tax wag the dog. Don't let tax dictate all your investment straight away. Maybe hold tight for your first year and just see how your investments perform, and then perhaps come up with some long-term plan as to where you want them. But it's definitely wrong to move your whole portfolio based just on the tax alone, unless of course you are going to a regime which will not tax anything at all. But that sort of planning is doable, but it's not everyday stuff, and it can be done. And I'm not going to go into too much more detail, but I am here, Matthew, and anybody else, to get into that sort of stuff. I've recently done one about some overseas, some offshore trusts and people sitting in the UK who are investing in those. And the question was, should they still continue to invest there? Is it a tax efficient thing to do? So yeah, it's a hot topic. It comes up a lot. Okay. All right, so that is, in a way, that is the end of my UK presentation. And that is essentially, I dealt with all the main issues that you brought up. There were some other cases. This is just my personal contact details. That's the main switchboard, and Yes, that's the main switchboard and my direct email address. You're very welcome to get in touch. I've got some other cases that I haven't even got to, whereby people were focusing on the host country. And I'll tell you what I mean by that. Just do a few quick cases very briefly. I had an inquiry from Tracy last week who was moving over to Spain, and she wanted to find out what the minimum resources or the minimum income requirement was in Spain. So that's not a UK issue at all, but I've worked on it and I know all about it. It is Brexit related. The rules have just changed in the last 6 weeks. There is no certainty yet on that issue, but we have worked on it. We are working on it, and those minimum resource tests will be enforced more now that we've gone past full Brexit, and there will be changes. What am I trying to say? There are regional differences in terms of what the minimum resources level are. Finally, I'm just going to sign off and say thank you for all your questions. It was excellent. Depending on your feedback, we may well do another one of these. I've got plenty of other topics to talk about, but I want to know how valuable you're finding them. We can think about the format or style of these broadcasts. But thank you very much for tuning in, and I've been Oliver Heslop. Cheers.